And now our top line story. Canadian Tire shares are not far off multi-year low levels. And the company's latest financial results are a vivid reminder of what investors have been worried about. With the Canadian economy slowing, so is consumer spending on non-essential items. The Canadian Tire numbers show that number vividly. Same-store sales fell by more than 1.5 percentage points, and the company cites a, quote, challenging consumer demand environment. To talk about it further, we're joined by our featured guest of the morning. He's John O'Connell, Chief Executive Officer of Davis Ray. John, first of all, thanks a lot for being here.
Thank you for having me.
Let's take a look at the particulars of Canadian Tire numbers. The story, without doubt, is declining same-store sales across all of Canadian Tire's banners. On a company-wide basis, same-store sales declined by 1.6%. At Canadian Tire itself, they fell by 0.6%. At Mark's Warehouse, the clothing retailer, they fell by 1.2%, and there was a big decline at Sport Chek. Now, that was made worse by the very mild winter weather we had. There was not a lot of demand for ski equipment and winter apparel, as you can imagine. With the very mild winter that we saw in much, not all, but in much of Canada in the first quarter and in the fourth quarter as well. The company cites consumer spending remaining down in a challenging consumer demand environment. And John, when some of our portfolio manager guests have been asked by callers, should I be buying this stock as it's near a 4-year low, many of them are very cautious on the name. They think that the macro environment here is not conducive to consumer discretionaries.
Yeah, I don't think it's anything to do with Canadian Tire management. I think it's to do with the Canadian consumer. You look at what's happened with Canadian Tire over the last 5 years, and basically you've made no money. And when you sort of look at the Canadian consumer, they've continued to go deeper and deeper into debt. So it's really not surprising. And while Canadian economic activity is growing, so GDP, that's the output of the whole economy, is growing, GDP per capita or per person is falling. So we have a major problem here. We have a housing affordability problem. We have too much debt, and we have people that have spent too much. You can't just blame it on seasonality. 5 years of 0% shareholder returns is saying something about the health of its customers. And that's one of the reasons why we just don't invest in Canada from an equity perspective, because it's just not it's a small market, one, and two, its customers, its consumers are heavily indebted, twice as indebted as the average American. And when you tell people that, when you tell Canadians that, they just look at there and say they can't believe that. They figure that Americans are these profligate people, and in fact, it's actually Canadians.
Do you see opportunities in consumer discretionaries in the U.S.?
I think that, the savings rate has been falling in the States recently. Credit card delinquencies are rising. They're back up to 2012 levels. I think you have to start to be cautious. Sport Chek, you look at the read-through from Nike, which is clearly losing its ability to attract customers. Starbucks, these are expensive items. And I think it's reasonable to think that as these rates have stayed at elevated levels, and they may stay at elevated levels for longer than most people think, that the lower income component of the population, let's say the bottom 25%, are really struggling. The good news about that is they only account for about 10% of the economy. Wealthy people are still doing well. Middle income is the area where you have to watch, and I think seeing the declining savings rate in America is a warning sign.